They are preparing for $30,000 gold. Not the guy shouting into a microphone on YouTube. Not the gold bug who's been saying the same thing for 40 years and is occasionally right. I mean, central banks. I mean, sovereign wealth funds. I mean, the people who move billions of dollars around the planet without ever once showing up on the evening news. And they are not preparing for it the way you'd prepare for a party. They're preparing for it the way you prepare for a storm you can already see forming on the radar, quietly, methodically, without announcing it, without a press release, without telling you until the thing they were preparing for has already started happening to your savings. Gold hit an all-time high earlier this year, then corrected nearly 30% in a matter of months. And everyday investors did exactly what everyday investors always do at moments like that. They got scared and they sold. Meanwhile, the biggest, most risk-conscious buyers on the planet did the opposite. They kept buying through the rally, through the crash, through all of it. That is not a coincidence, and it's not noise. That is a signal, and it's one of the clearest signals I've seen in my entire career. By the time this video is over, you're going to understand exactly what that signal means, why almost this exact pattern has played out again and again throughout history, and why, if you ignore it, you could end up on the losing side of the biggest quiet wealth transfer of your lifetime without ever fully understanding why it happened to you. This isn't a prediction I'm making to sound dramatic. It's a pattern I've watched play out before, and once you see it, you can't really unsee it. Before I go any further, let me say something plainly, because I want you to actually trust what I'm about to tell you. What I'm going to walk you through in the next few minutes took me years of watching full market cycles play out, making real mistakes with real money, and eventually sitting down and forcing myself to understand exactly why those mistakes happen. I'm not selling you a course. I'm not selling you a fund. I don't have a sponsor whispering in my ear about what I can and can't say here. If this video keeps you from making one bad decision with money you spent your whole life earning, it's done its job completely. So if that's worth something to you, subscribe right now before you keep watching, because I'm not going to repeat this framework a second time in some other video. And most people who genuinely need to hear this only stumble onto it once in their life. And a lot of them stumble onto it too late. Let's start with what's actually happening on the ground, because most of what you're hearing about gold in the financial media right now is just noise dressed up as analysis. And I want to cut straight through it. Gold spiked to an all-time high earlier this year, north of $5,500 an ounce, the capstone of one of the strongest multi-year runs the metal has ever had. Then it corrected hard down close to 30% from that peak in a fairly short window. If you only read the headlines during that drop, you'd think gold was falling apart, that the whole story was over. Retail investors clearly believed that everyday people pull billions of dollars out of gold funds during the correction, because that's what everyday investors do almost without fail. They buy when something already feels safe and popular, and they sell the moment it feels scary, which is precisely backwards from how you actually build wealth across a full cycle. But here's the part that never makes the headlines, because it doesn't happen on a trading floor with cameras around. While retail money was heading for the exits, central banks kept buying, not a token amount, aggressively and consistently. For several years now, central banks around the world have been adding gold to their reserves at a pace we haven't seen in decades. some years setting outright records for annual purchases. This is not a hobby for these institutions. Central banks do not buy assets because they like how something looks in a vault. They buy because they are managing risk on a scale most of us will never personally have to think about. Trillions of dollars in national reserves that need to hold real value through wars, defaults, sanctions, currency crises, and everything else history has a habit of throwing at a country. When that entire group, acting independently of each other across dozens of countries, quietly shifts a growing share of their reserves into gold year after year, through a rally and straight through a correction that scares everyone else out. That's not speculation. That's insurance. And serious insurance only gets bought by people who have personally seen the fire before and know exactly what it looks like when it starts. So why gold and why now specifically? To really understand that, you have to understand something most people are never actually taught, which is how the machine underneath all of this works. Every country, over long enough stretches of time, moves through what I call a debt cycle. Governments spend more money than they collect. That's not some rare scandal. That's basically the default setting for nearly every government in the modern world, regardless of who's in charge or what they promised in the campaign. To cover that gap between spending and revenue, they borrow. And for a good while, that's completely fine. The economy grows, the debt gets serviced without much drama, interest gets paid, and nobody outside of a finance department really notices or cares. But debt compounds. It always compounds quietly in the background while everyone's attention is somewhere else. And at a certain point, the total amount owed gets so large relative to the size of the actual economy underneath it that there are only really a handful of ways out of that hole. You can raise taxes and cut spending hard enough to close the gap, which is enormously painful and close to political suicide. So almost no government ever does enough of it fast enough to actually fix the problem. You can default outright, which shreds trust and access to credit markets overnight and tends to trigger a crisis all on its own. Or, and this is the option that gets quietly chosen almost every single time, across almost every country, across almost every era, you print more money and you let the currency slowly lose value so that the debt effectively shrinks in real terms, even though the number printed on the page never changes. That third option is the one governments keep reaching for over and over because it's the only one that doesn't require standing up in front of voters and admitting a painful truth out loud. It just requires patience. And it counts on most people never noticing the mechanism at work until it has already happened to them. Here's why that should scare you specifically, and not just as some abstract economics lecture. When a currency gets devalued this way, it doesn't hit everyone equally, and it's not random who gets hurt. It hits savers the hardest every single time. If the bulk of your wealth sits in cash or in assets denominated in a currency that's quietly being diluted year after year, you don't lose that money in one dramatic headline-grabbing crash that you'd immediately notice and react to. You lose it slowly, gradually, in a way that's almost designed to go unnoticed. 5% of real value gone 1 year, another 5% the next. compounding quietly in the background while your bank statement still proudly shows the exact same number it showed last year, giving you a completely false sense that nothing at all is wrong. Meanwhile, people who are positioned in hard assets, things that physically cannot be printed into existence by any central bank, no matter how badly they might want to, actually gain purchasing power across that same stretch of time. That is the wealth transfer I mentioned right at the start of this video. It is not a conspiracy theory. Nobody is meeting in a basement somewhere to plan it. It is simply the mechanical, almost the boring result of currency debasement playing out exactly as it always has, and it happens to whoever isn't paying attention. Every single time this cycle runs its course, in every country where it has ever happened, central banks are buying gold aggressively right now at these levels after a sharp correction. At the exact moment, regular people are selling out of fear. That is those institutions positioning themselves on the winning side of that transfer quietly before most of the public even understands the game being played around them. There's another piece of this that almost nobody talks about, and it's worth sitting with for a second because it's the reason this whole process can run for years without most people noticing it's even happening. Governments have a strong incentive to make currency debasement look smaller than it actually is. And one of the quietest ways they do that is through how inflation gets officially measured. The number you see reported on the news each month is built from a specific basket of goods using a specific methodology that gets adjusted and reweighted over time in ways that consistently make the reported figure look milder than what people are actually feeling at the grocery store, at the pump, and when the rent renewal notice shows up. This isn't some wild accusation on my part. It's a well-documented pattern, and it's not unique to any one country. The practical effect is that a lot of people look at the official number, feel reassured that things are basically fine, and never connect the dots between that comforting headline figure and the fact that their savings account sitting in cash is quietly losing real purchasing power every single year, regardless of what the official number says. That gap between the reported story and the actual lived experience is exactly where the wealth transfer I keep mentioning does its work, mostly unnoticed, for years at a stretch, until eventually the gap becomes too large to paper over any longer. And I want to be completely clear about one more thing. This is not a new story, and it's not unique to right now. This has happened before, more than once, in more than one country. And once you understand the underlying pattern, the current moment stops looking mysterious and starts looking almost familiar, like you've read this exact chapter somewhere before. Go back to the 1970s. The United States had been running large deficits. The dollar had recently been unofficially cut loose from any connection to gold, and inflation started running hot, eventually climbing into the double digits for years at a stretch. Anyone sitting in cash through that entire decade watched their real purchasing power get cut roughly in half without a single dramatic headline forcing them to notice it happening in real time. Gold, on the other hand, went from around $35 an ounce to well over $800 an ounce by the end of that same decade, a move of more than 20 times over. That wasn't luck, and it wasn't a random speculative mania. That was the market slowly repricing gold to reflect what had actually already happened to the value of the dollar sitting underneath it the whole time. Push further back in history, and you'll find the exact same basic mechanism repeating near the end of nearly every major empire's period of dominance. Heavy borrowing, followed by currency debasement, followed by a late scramble into hard assets by whoever finally figured out what was happening early enough to still do something about it. Ancient Rome literally shaved the silver content out of its own coins over decades to stretch its budget further, and its citizens paid for that decision through generations of inflation. Most of them never fully understood while it was happening to them. Or look at Germany in the early 1920s, a more extreme version of the same story, where a government drowning in war debt simply printed its way out, and the currency collapsed so completely that people were reportedly burning stacks of banknotes for warmth because the paper was worth less than the firewood it could have death. Or nobody living through the early years of that decade thought it would end that way. The people who protected themselves were the ones who had already moved a portion of their savings into hard assets, land, gold, foreign currency, years before the worst of it hit, not the ones who waited for confirmation. The names change, the decades change, the specific currency changes. The underlying mechanism never does. And what tends to separate the people who come out ahead from the people who get quietly wiped out isn't intelligence, and it isn't luck. It's simply whether they recognize the pattern early enough to act, or whether they waited until it was obvious to absolutely everyone, which by definition is usually the exact moment it's already too late to do very much about it. So is $30,000 gold realistic, or is that just a number designed purely to grab your attention and get you to click on this video? Here's my honest answer, and I'd rather give you an honest answer than a satisfying one. I don't know the exact number, and frankly, neither does anyone else who tells you they know it with total, unwavering confidence. Anyone selling you certainty about one specific price target years out, dressed up as fact, is selling you a story, not a real analysis. What I do know with a much higher degree of confidence is the direction of the underlying forces at work here. Government debt levels measured as a share of the overall economy are historically elevated across most of the developed world right now. Not just in the United States, deficits keep growing year after year regardless of which party happens to be in power, because meaningfully cutting spending is politically expensive, and almost nobody in office wants to be the one who actually does it. Central banks have already shown you through their own real buying behavior over the last several years that they see the same underlying risk I'm describing to you right now, and they are actively hedging against it with real capital, not just with reassuring words in a press conference. When you put all of those pieces together, historically high debt levels, deficits that keep growing no matter who's elected, and the institutions that manage the world's reserves quietly stockpiling gold through both rallies and painful corrections alike, you don't need a crystal ball to see roughly where the pressure is pointing. You just need to accept that this is a slow, mechanical process playing out over years, not some single dramatic headline event you'll see coming. And slow mechanical processes like this one tend to keep moving in the same direction for a very long time until something fundamental actually changes underneath them. Now, what do you actually do with all of this? Because understanding a problem without ever acting on it is just anxiety wearing a nicer outfit. I am not going to sit here and tell you to dump every dollar of your savings into gold coins tomorrow morning. That would be every bit as reckless as ignoring this entire conversation. And anyone who tells you to go all in on a single asset, whatever that asset happens to be, simply does not understand risk the way they should. What I will tell you is the one principle that has genuinely guided me through every cycle I've personally lived through, made money in, and occasionally gotten badly burned along the way. Don't hold all of your wealth in one single type of asset, and especially not concentrated entirely in one currency, no matter how completely safe that currency has felt to you your entire life. Because has always felt safe and will always be safe are two very different statements, and history does not treat them as the same thing. Go look at how your own savings are actually allocated right now, today, honestly, not how you assume they're spread out in the back of your mind, but how they are genuinely positioned when you actually pull up the numbers. If the overwhelming majority of what you own sits in cash or cash equivalents in a single currency, you are, whether you've consciously realized it or not, making a large, concentrated bet that everything I just walked you through in this video simply won't happen to you personally. That might end up being a bet you're genuinely comfortable making with open eyes, but it should be a decision you make on purpose, having actually thought it through, not some default you quietly fell into over the years because nobody ever bothered to sit you down and explain the mechanism behind it. Hard assets, gold being the oldest and by far the most historically tested one we have on record, exists for exactly this kind of scenario, not to make you rich by next Tuesday, to make sure that when currencies eventually do get devalued, which historically speaking they always eventually do, you are not left holding the bag entirely alone while the institutions that saw it coming years in advance are sitting comfortably on the other side of that same trade. If I had to boil this down into a few practical ideas you could actually use instead of just a warning, it would look something like this. First, know what you actually own in plain terms, not in vague categories. Sit down and write out exactly what percentage of your total savings is cash, what percentage is in stocks, what percentage is in real assets like property or gold. And look at that list honestly instead of guessing. Second, resist the urge to make any of this an all or nothing decision, because the people who get hurt worst in these cycles are almost never the ones who ignored the risk entirely. They're the ones who panicked late and moved everything at once in either direction, right at the worst possible moment. Building resilience into your savings is something you do gradually, over time, not something you do in a single dramatic afternoon after watching a video like this one. Third, pay far more attention to what large, risk-conscious institutions are actually doing with their own capital than to what any single voice, including mine, is telling you to do with yours. I can hand you a framework for understanding the situation. I can't hand you certainty about exactly how it plays out. And you should be skeptical of anyone who claims they can. I'll leave you with this thought. Every single generation convinces itself that its own economic situation is somehow completely unprecedented, and almost every generation turns out to be wrong about that, because this exact mechanism has played out again and again throughout recorded history, just wearing different currencies and attached to different decades. Each time it shows up, The people who actually protected themselves through these moments weren't smarter than everyone else around them, and they usually weren't luckier either. They simply paid close attention to what the biggest, most risk-conscious institutions on the entire planet were actually doing with their own money, instead of getting distracted by whatever those same institutions happened to be saying in a press release that week. Right now, today, those institutions are telling you something extremely clearly through their actions, even while the mainstream headlines stay almost completely quiet about it. My challenge to you, and I mean this sincerely, is simple. Go look honestly at your own portfolio this week, not sometime next month when it's convenient, this week, and ask yourself whether you are actually positioned for the world as it truly is right now, or for the world as you'd simply prefer it to be, because those are two very different worlds, and only one of them will actually protect you when the difference finally matters. If this video helped you see something you hadn't fully seen before, subscribe, because I intend to keep breaking down exactly what the smart money is quietly doing with their capital, not just what they're publicly saying about it. And drop a comment telling me honestly where your own savings sit right now, because I genuinely read every single one, and I want to know if any part of this actually changed how you're thinking about your own money. Not because I need the validation, but because the whole reason I keep making these videos is to catch people before the cycle finishes playing out, not after. And the comment section is usually where I find out whether that what's actually working